Hi guys. This is Richard Perry. Welcome to my latest webinar with FX Street. Thank you very much for joining me today. I hope you're all okay. I'm going to talk about today is central bank monetary policy. Now, the reason I wanted to talk about this is because of what I think could be an enormously interesting central bank monetary announcement tomorrow coming from the Federal Reserve. And I thought it might be a bit interesting to just delve into a little bit more and give you an idea as to exactly what might happen and the impact of it, but also sort of go through the general theory of monetary policy and how it impacts on forex markets and also equities and the like. So let me get on with this now. Right, here's my risk warning, and you need that because I'm going to talk about live charts towards the end, and therefore you need to understand that the risk warning that I've got here. I'm going to put it up towards the end just in case you haven't had a chance to read it, but there it is in all its glory. Bit about me. I'm now here 14 years. Wow, that was 13 last time I did this. Interesting. But yeah, so in my 14th year of working in the city, so I'm hoping that what I can talk to you about today, you trust me and think that I know what I'm talking about. Many would disagree, but there we go. That's another story. Anyway, my webinar agenda today is we're going to focus first of all on a little bit of theory. What do central banks do in terms of how they engage monetary policy? I'm going to then talk about the markets that central bank monetary policy impact on and the various instruments. And then just a touch on some strategies if you are going to play the fundamental news flow, which is a difficult trade in itself, playing fundamental trades. But if you're going to do that, then maybe a bit of a strategy for you. And then I'm going to do current market analysis, which is just a technical, if I can spell, which I haven't here, technical market appraisal of key forex majors, indices and gold. And throughout, basically, if you've got any questions, please feel free to ask. And I'll see what I can do. I've got the chat box open. I'm presuming that you're going to be writing in the chat box. I didn't see a question box anyway. I might be wrong. Anyway, so on to what central banks do. Okay. Now, broadly speaking, they decide on monetary policy, and monetary policy is the tightening or loosening of interest rates at a fundamental level. Now, tightening is a rate hike, so increasing interest rates. And loosening monetary policy is a rate cut. Now, in recent years, obviously, central banks have got to such a low level on interest rates that they've had to engage in unconventional measures. And those unconventional measures have given light to what we now know as quantitative easing, something that I'm sure a lot of you have heard of and is obviously still big business. And that has a big impact on central bank monetary policy as well. Central banks also provide forward guidance in terms of what they're going to be looking out to be doing in the coming months, and also do things like providing inflation and growth expectations and targets. But it's all basically key because it sets expectations for future rate policy, and therefore that has a big impact on bond markets and currencies as well. Okay, so first of all, just very quickly at looking at statements. Now, statements are vital because they are the formal measure through which central banks give their monetary policy. And as we all know, or what we'll be looking out for tomorrow, is that single words can make a difference. And certainly with the Federal Reserve, for example, they have a set predefined set of terminology that they have in their statements that can make a big difference, and that the current word is patient in terms of rate hikes and monetary policy tightening for the Federal Reserve, and that one single word everyone is fixated on at the moment, and that is going to be the big focus for tomorrow's FOMC statement. So just the wording itself can be vital in terms of forward guidance. So the FOMC previously said that it would retain the level at 0.25 on the Fed funds rate for a considerable time. and that was removed in December and replaced by, or generally that was taken out of the statement, and now patient is the key word that everyone is looking out for. And basically that word patient is driving the expectations of when the when the Federal Reserve is looking to start to tighten interest rates, because basically said, Janet Yellen said in her press conference that whilst patient was in the official statement, then that would mean that the Federal Reserve would maintain its current monetary policy for at least the next 2 meetings. The Federal Reserve also gives things like dot plots as well, which are basically the expectations of where each of the members are looking to have growth and inflation expectations in the coming months. Right, so press conferences. Basically, the press conference, for example, the press conference that Janet Yellen will give tomorrow, they'll put a statement out first, and then I think it's half an hour, although I might be wrong, after the official statement is released, then they have a press conference, basically just to provide further information, because the official statement can often provide volatility in the markets, and press conferences can help to calm the markets down. Say, for example, if they were making a big move, but also equally, if they don't make an official change to the monetary policy, then the press conferences can actually create volatility. If say, for example, Janet Yellen was asked a question and she gave a little bit too much information, then that may have a driving force on certain markets. So basically, the outlook in the press conference is also very important as well. And then you've got the central bank meeting minutes, which generally tends to happen a couple of weeks after the meeting, and it basically just is a historical account of exactly who, sort of what people have been saying in the meeting and who's been voting for certain decisions, for example. And it's at that point at which you start to look at also the voting makeup and who has voted for what, and whether they're hawkish, whether they're dovish, and their historical leanings in terms of voting. So that all becomes very interesting as well. So the other communications include, as I said, inflation and growth forecasts. Now, every other meeting for the ECB and the FOMC, they provide, the staff of the central banks provide their inflation and growth forecasts. And the Bank of England does it at a separate press conference, and that is called the quarterly inflation report. And that also is as once a quarter, so that's every 3 meetings for the Bank of England. And we've also got then just general speeches by central bank members, such as the Janet Yellen would give a testimony before Congress. Mark Carney of the Bank of England has to sit before the House Select Committee into Financial Services. I can't remember what it's called, whether it is called that or not. Who knows? Anyway, but basically they all have to answer questions to the MPs, and that again can give you a leading influence on what the central bank monetary policy is going to be. And finally, also committee members give their own speeches as well, it's basically that is the point at which you start to get a history of what the specific members have in terms of their opinions, because it's very interesting going forward in terms of how the voting makeup of the certain committees are. Now, the current voting makeup on the FOMC is there are no natural hawks actually sitting on the committee at the moment, and that is interesting, and I'll show you a table in a minute that just shows you that. There are actually just pretty much 2 centrists, which are Lacker and Powell, and most of the others are basically classed as dubs. So that would suggest that there is a natural tendency towards leaning on conservative moves in terms of central bank monetary policy and tightening. Now, in terms of the ECB, now obviously 2014 was, I mean, it was well chronicled in terms of the battle between Draghi and the Germanic hawks such as Jens Weidmann in terms of how the ECB would go with regard to their quantitative easing move or their monetary policy easing. And eventually, Draghi appears to have won that argument because obviously the ECB has subsequently eased monetary policy further. Let me just have a quick look at some of these questions. Brilliant. Nothing. Sorry, no, I was just reading a couple. Right, sorry. And finally, the Bank of England. There are two natural hawks on the Bank of England, Martin Wheal and Ian McCafferty. And there are other two that are slightly dormant, arguably, which is Kristen Forbes and Nemet Shafiq. And it's interesting because there's only 9 members on the Bank of England MPC. So that would suggest that it maybe wouldn't take a great deal for them to start hiking interest rates because Martin Wheal and Ian McCafferty have a history of having hawkish stance. And then Forbes and Shafiq are considered to be on the brink of turning hawkish as well. So it would only need one other member to turn hawkish in order to get an interest rate rise on the Bank of England. So very much worth watching out for the Bank of England meeting minutes in terms of how they're voting. Wheal and McCafferty have recently changed back from looking at interest rate hikes towards keeping flat, but Martin Wheal is still sort of teetering on the brink of going back again. And subsequently, as I said, member speeches can be key. So what you'd be looking out for is when a dove makes a hawkish speech, and that would be something that the markets would take notice of. And on the other way around, you'd be looking out for a hawk making potentially a dovish shift of stance, because all these things can have a big impact on the meeting, on the voting structure. Now, what we have now is this table was taken from last year actually, sort of sourced from Deutsche Bank, and it shows you the Federal Reserve FOMC makeup of the voting members. That's key in itself, voting members, because there are 2, 4, 6, 8, 10 voting members on the FOMC, and then there's another, I think, 8 or so non-voting members, and they basically go on a 3-year cycle of in and out of voting on a number of them. I think it's 5 of them are on rotation at any one time. Now, what you can see here is this is the scale of dovish to hawkish, so dovish being 1, hawkish being 5. And you can see that they had 2 major hawks, Charles Plosser and Richard Fisher, and also Loretta Mester was a sort of a marginal hawk. But they actually got removed on rotation from the FOMC last year at the turn of the year, and they were replaced by Charles Evans, Jeffrey Lacker, Dennis Lockhart, and John Williams, all of which, apart from Lacker, all of which were doves. So all these hawks were replaced by doves on the committee, and you can see the average ranking here that Deutsche Bank have given them, the change from 2.6 to 1.8, so which suggests that the FOMC is naturally dovish in its makeup, and that is an important thing to remind people, because regardless of what's going on in the markets, if it's got naturally dovish members on the FOMC, then that may well mean that monetary policy's tightening is sort of slightly delayed potentially. So that is an interesting point to note. Right, now the impact of monetary policy on the markets. Now, central banks have had a more of an impact in recent months on the markets, and certainly since 2014 this has been significantly the case. And the question is why? And the answer is policy divergence is massive in terms of currency moves. When you have 2 central banks on the currency pair, such as euro dollar, ECB and the Federal Reserve, when you have 2 central banks that are going in opposite ways in terms of their monetary policy, as you do at the moment, that can have enormous impact on the currency. Now, what we have at the moment is the the ECB, which has just engaged 60 billion euros of quantitative easing every month for the next 18 months to take it to 1.1 trillion euros worth of quantitative easing. And you've got the Federal Reserve, which has finished its quantitative easing, and it's now on the brink of looking to tighten interest rates, looking to increase interest rates. Now, the difference in that is enormous in terms of all sorts of markets, really. That has a massive impact on bonds, on treasuries, on sovereign Eurozone debt, and also on the currency as well. And that has a big... That is, it's a big move. And basically, the FOMC is not alone in this. It looks like the Bank of England is also beginning to sort of move towards tightening in 2015, and it certainly looks as though the likelihood is that's going to be at the earliest probably Q4. I'm going to put my neck on the line, maybe Q4. And you can get a gauge of these things. And what I'll do now, very quickly, actually, just come up with this. Look at the Fed funds for the. This is the interest rate expectations. I don't know whether you can actually see this. It's not. I apologise if you can't see that. But basically, the Fed funds interest rate futures can give you an idea of when the market is expecting the rate hikes in the US, and at the moment you're sort of looking out for, certainly when you get back towards sort of the bottom, you take, basically it's the opposite, so it's 99.75 would be a 25 basis point interest rate, and then 99.5 would be your that one that's just turned yellow there, 99.48 is basically when the market is sort of almost guaranteeing that is going to be where the interest rate's going to be at that time. So December 2015, they're sort of saying almost nailed on that it's going to be then. So it's when you start to move away from this. As you can see in August, you've dropped below 99.75, so you're beginning to move into Q3 2015 is when the market is beginning to expect the rate hike. So Fed funds interest rate futures are interesting on that. Oh no, what's happened there? That's so annoying. Okay, there you go. So if you've got access to that information, that is very interesting as well. So basically, the other factor is expectations versus actuals are incredibly important as well when it comes to pretty much any fundamental announcement really, but obviously on interest rates it's massive, because when a central bank does a surprise rate cut or a rate hike, that has a massive impact on the currency. And we've had recently some surprise rate cuts from the likes of the Bank of Canada and also the Reserve Bank of Australia. And the Reserve Bank of Australia fell away, obviously, on that rate cut. And there was actually also, bear in mind that you can have a surprise hold on interest rates as well when the market is expecting a rate cut and it actually doesn't cut interest rates. And it was interesting because in the last couple of months we've had a surprise rate cut and a surprise rate hold by the Reserve Bank of Australia, both of which have caused volatility in the Aussie and impacted on the price of Aussie dollar. So that's an interesting point to make. Question: what is yield from a deal? Okay, you might have to explain that question a little bit more than that. What is yield? Do you mean bond yields? Then if that is the case, then I will just quickly run through this chart, this table here. But okay, so right, just going through this table here on this slide. Basically, what we're looking out for on the FOMC is a potential hawkish move. Now, that's going to have an impact across markets. You're going to have an impact on the dollar. You're going to have an impact on Wall Street, which is equities. You're going to have an impact on US Treasury yields. And also, you're going to have an impact across commodity markets as well. Pretty much everything is going to be impacted by this potential hawkish move tomorrow. So if a hawkish move is seen, that would be suggestive of tomorrow. They're not going to hike interest rates tomorrow. You're not going to see an interest rate move to the upside. However, you're going to see a change in the statement that would suggest perhaps they're going to be positioning themselves for a rate hike. Now, at the moment, the market is pricing in, as I said, on those Fed funds futures, around about September is where we're beginning to get more likely that we're going to get a rate hike. In terms of the Fed funds futures, they're around about 55% suggesting it's going to be September. Now, if the Federal Reserve change their statement tomorrow, which is likely, that Fed funds rate will come in tighter, and the expectation will probably move to the July meeting, which is on the 29th of July. Now, the impact that's going to have on the dollar. This would a hawkish move by the Fed tomorrow would be bullish for the dollar. This is I'm going to say this is theoretical because you've already had such a huge move, but that could have implications for the market as well. But I'll quickly run through that in a second. But first of all, theoretically, a hawkish move is bullish for the dollar because it suggests that the interest rate basically if you hike interest rates, it basically means that you get more interest on holding the currency in that local exchange rate, in that local currency. Sorry. So therefore, you get more interest back for your money, and therefore subsequently if that's going to happen, then dollar relative to other currencies, that would be positive for the dollar because that would improve hot money flows into the dollar. And certainly the expectation of this move towards a rate hike has been seen in the past 8 months and driven a dollar rally, a massive dollar rally in the last 8 months. You've seen the dollar appreciating by 25% on the dollar index, an incredible move. But the question, I suppose, is how much is already priced in? So that is the big question. Now, in terms of Wall Street, theoretically, a hawkish move by the Federal Reserve could actually have an impact both ways. And the reason is because you could take interest rate hike as one of two ways. Either the fact that the reason the Federal Reserve would be increasing interest rates would be because they have faith in the economy and the economy is growing strongly, and the economic recovery is very positive. Now that would drive an interest rate hike because normalized rates should be maybe around 3% in the US, whereas at the moment they're 0.25. So the Federal Reserve would, in the long term, want interest rates back higher so that they can then have the flexibility to cut interest rates again if the economic conditions deemed that was to be necessary. Now, so that would suggest that a strong economy should be strong for stocks. But you could take it the other way, that an interest rate hike is negative due to the fact that it would it would mean the dollar would be strengthening, and for the exporters, which would have an impact on Wall Street. Certainly, the exporters would have more of a struggle in terms of their exporting, because prices abroad, prices to buy US dollar denominated goods would be higher in local currency abroad. And also on Treasury yields. Now, the expectations, as I said earlier, would be that fixed income assets would be sold off because of the relative difference between interest rates and when interest rates are going up, then fixed income assets are sold off because of the fact that it's a fixed income, and instead of sort of getting, say for example, at 1%, if you had bought a bond yielding 1% and the interest rates went from 1% to 2%, you'd rather hold cash than hold the bonds, so you'd sell off the bond. So that would push the yield up, because bond yields and bond prices are negatively correlated. And finally, on commodities. Now, this is an interesting one. Again, Now, the fact is that at the moment, you've seen commodity prices around the world absolutely tanking. Gold, silver, massively lower. Oil price falling to a new 6-year low today, and that is coming on the back of this strong dollar, because these assets are denominated in dollars. Again, in terms of the fixed price nature of that, that would mean that a strengthening dollar is negative for the commodity prices. And hence you get a significant sell-off in those. Okay, very quickly on the ECB, dovish moves by the ECB is bearish for the euro in the same way that a hawkish move is bullish for the dollar. A dovish comment from the ECB would be bearish for the euro. So that would be sending euro dollar, euro sterling, euro Japanese yen all lower. It would also be bearish for sovereign bond yields, and I stress that yields because again, when interest rates are cut, that is positive for bonds because again, from the fixed income nature of the asset, that it puts traders into bonds, and hence the bond yields go down, which is why you're seeing bond yields at record lows. Also, the fact is that the ECB is engaging quantitative easing, which is buying of sovereign bonds, and hence you buy a bond and the yield goes down. So that's why you're seeing bond yields in the sovereign debt markets at record lows, and some even into negative territory, which is an interesting topic in itself. And also a dovish comment would be bullish for Eurozone equities, which is why you're seeing the DAX absolutely flying at the moment, because you've got the ECB quantitative easing and you've got the potential for well, let me just quickly run through what happens on quantitative easing. What you do is you have quantitative easing, which has massively boosted equity markets on an indirect basis for several years, actually. You could even argue that, a lot of people argue that quantitative easing, without quantitative easing, the stellar gains that we've seen on the markets around the world would not have happened. Now, the quantitative easing works by the central bank buying low-yielding assets, such as sovereign bonds, off the balance sheets of financial companies, and in return that basically frees up the balance sheets for those companies to go out and buy higher yielding assets, and that's why basically equity markets go up, because they yield more than bonds do, and because of the risk, in theory, and hence you see equity markets flying higher, and buying with the ECB through its various central bank, various sovereign central banks, buying up sovereign bond yields, hence the DAX, the CAC, and the FTSE MIB all flying higher at the moment. And although you could argue not today, but still, the record run on the DAX has been just incredible, from 11,000 up to 12,000 in a space of probably 2 or 3 weeks, actually. So it's been an incredible move. So in terms of, I haven't done a little table on the Bank of England here, but as I said earlier, the quarterly inflation report is the thing that I think at the moment you need to be looking out for on the Bank of England, or historically anyway, certainly for the last 6 years or so, since the Bank of England has basically not moved on their interest rates. Yeah, you've had a few bouts of quantitative easing along the way, but you haven't had any QE from the Bank of England for a good 2 years, I think now. So you're looking more for information out from the quarterly inflation report. Basically, that gives you inflation targets and growth targets, and that can drive expectations of monetary policy. The other thing is that so I suppose the takeaway from that would be any improvement in growth expectations is seen as hawkish, and also any sort of pickup in inflation is also seen as hawkish, because one way to battle inflation is to hike interest rates. So hence when you see inflation going up, that is one way of battling inflation. Right, now I'm going to show you a few charts here. This is monetary policy in practice. This is euro dollar on and the S&P 500 after the FOMC statement on the 28th. What? That's not even close to being right. That should be 28th of January. Sorry, I really apologise for that. 28th of January. Got my dates wrong. Anyway, okay, so at 7 o'clock in the evening, you had the hawkish move on the FOMC by removing considerable time and replacing it with sort of keeping patient, but that is the main word that now is on the FOMC statement. Now that is seen as a hawkish move, and you saw an initial spike higher on the euro dollar, but that was more of a volatile move because you saw this volatile move, and then suddenly after about 10 minutes you get this consistent selling pressure through on the FOMC statement. So big sharp move lower. The same sort of movement we saw through the S&P 500. Actually, this is the S&P 500. Again, a slight jump higher, but then subsequently, after a minute, it only took a minute for the S&P 500 to really get cotton on to the fact this was a hawkish move. And at the moment, hawkish moves or hawkish expectations on the FOMC are being seen as negative for equities in the States. Hence why we're seeing the S&P 500 really quite badly underperforming, say, for example, the DAX. Big difference between those two there. And we've seen on 28th of Jan, you saw the S&P 500 fall from 2,034 down to 2,004 within the space of an hour and a half, hour and three quarters. So that was what, 1.5%, which is a fairly big move on the S&P 500 in that time. So that was an interesting move there. And this is euro dollar during Mario Draghi's ECB press conference on the 5th of March. Now that date is correct. Anyway, right. Okay, so you'll see here that the euro dollar basically did nothing in front of the FOMC in front of the ECB press conference. In fact, I should have done it a little bit further back than that. I apologise, because it would have shown that the actual announcement of the monetary policy statement comes at 12:45, and UK time, this is 12:45, and there was nothing. So there was no movement there. So no movement up until the statement, and then suddenly during the statement, when he reads out the actual statement of his monetary policy, you had a jump higher, and that was because he started talking about growth forecasts in this time here. So during the time he was talking about improving growth in the Eurozone, the euro started to strengthen, and then it started to settle down. And the reason it started to settle down and then subsequently sell off was because he then started talking about lower inflation, and also the fact of lower inflation for longer, and also the fact that he would engage quantitative easing with negative negative interest rate purchases, which would give him the ability to, or give the ECB the ability to buy sovereign debt with a yield of as low as negative 0.2%. So subsequently, the euro sold off quite significantly. So it went from a peak of around 111 down to below down to about 110. Actually, it got in the space of the meeting. So a big move, big turnaround within the meeting. So you've got to look during the press conference. You've got to look out for specific things within the meeting. So if it's anything hawkish, the euro is going to go up. If it's anything dovish or negative for the eurozone, it's going to go down. Okay, this is euro dollar just across 2014 really, and just to show you the massive impact that Mario Draghi and the ECB have had on the eurozone, on the ECB, on the euro throughout that year. This was the day that this is the press conference up here on I can't remember the exact day. I'm going to say that's sort of 7th of May or something. On that day, you had the press conference for the ECB, and that was the first time that Mario Draghi started to talk about monetary easing within the Eurozone. The first time he mentioned it, we got to a high of 139.92, and then he started talking about monetary easing. And at that stage, the euro went south, and it hasn't stopped since. It's barely even looked back. It fell from basically 140 back to this was taken earlier, so 106. Basically 106 figure is where it is at the moment. So 3,400 pips to the downside in all that time. So it's interesting here also on this chart this is where ECB formally announced quantitative easing on this date here on the 22nd of January. And you saw another big sell-off on that meeting, and it sort of slightly bounced, but then suddenly, again, it's just taken off to the downside once more. So really, really interesting moves there on the euro, on the back of ECB announcements. This is sterling dollar to show you something else. This is Mark Carney's quarterly inflation report. Press conference on the 12th of February. This was between 10:30 and 11:30 GMT in the morning. What you can see here is didn't do a great deal, and maybe fell. It was about 40 pips actually. So okay, fine. Through the morning, just dropped off, settled down in front of the inflation report, and then suddenly the inflation report on his statement in that inflation report, which was seen as being generally hawkish, the cable absolutely took off and went from 52.20 and added about 140 pips in the next hour, or no, that's even less than that. It's about 40 minutes, and then started to settle down a bit. But you can see that you had a massive run higher in the 40 minutes during that press conference, as Mark Carney was sort of tending to move to. He was trying not to, but he was sort of giving sort of expectations of improved growth, and also is talking about the fact that inflation in the UK is generally seen as being sort of short term and only just a function of the oil price, and it would tend to drop out in the latter part of the year. So very interesting move on that cable. This is the Aussie on those two rate moves that I talked about, the February meeting and the March meeting. The Aussie, we had a surprise rate cut in the February meeting. Bang. Absolutely 100 pips to the downside, gone in the space of a couple of minutes. So, and then it continued to go lower across the next few minutes as well. So very interesting move. Here we have the Aussie on the next meeting, the March meeting, when the RBA was expected to move on interest rates, again expected to cut rates, but they didn't. They did nothing. They sat on their hands, and it was a surprise for a lot of people. Markets had forecast a rate cut, no rate cut, and that was seen as a hawkish move, obviously. And then suddenly you had the Aussie, which jumped about 60 ticks in the space of just a few minutes. So these interest rate moves, or the the monetary policy moves, can have a big impact on these markets. Right, so how do you incorporate monetary policy decisions into your trading? Basically, just be very careful in front of the decision, as that Aussie chart shows you. You can go both ways, so just be careful, because a surprise rate move can mean that you get stopped out. So you need to have, if you're going to run a position over these monetary policy meetings, you need to make sure that your stops and your risk reward are adequately placed. I specifically stress on risk reward as well. Say, for example, you've been sitting in a trade for a while, you're sitting on a nice profit. Do you want to risk losing that profit on the rate move? Well, just be very careful is what I would say. Basically, because you can get very big moves on the monetary policy decisions, as I've just shown you, especially on surprises. So the point would be, ultimately, if you do get a surprise, trade in the direction of the surprise. So if you get a surprise rate hike, then you want to go long on that local currency. If you get surprise rate cut, you want to go short. And as ever, I would say pretty much across the board, economic data is you need to stay close to your trade, because you can. I mean, for example, during as you saw during that ECB press conference, when Mario Draghi was playing around and talking about growth and inflation, it can have two different a different impact on the rate. And obviously, the other thing being major shifts of policy can induce massive moves. I mean, look at the DAX and also the DAX in recent times, and also the euro since May. Right, now I'm going to just have a quick look at some of these charts here. This is the euro. You don't get that very well, do you? Okay, here's the euro. What are you looking at the moment? This is, sorry, excuse me. This is the euro. Sorry, I'm just going to have a drink. A little bit of a cold, doesn't it help? Okay, this is the euro. And I'm going to just look at the technicals on the euro, because obviously the euro has been under a significant amount of selling pressure in recent months. I'm actually going to squeeze that, because that doesn't... Why is it doing that? It's very tedious. It doesn't look very good at all. Anyway, this is the euro across the last few months, and certainly the pressure to the downside is key. Now, this is a Fibonacci move, which gives us a target, a downside target of 61.8%, which is around the 106.20 mark, and that is where it's consolidating at the moment. So that is very interesting. Technically, I think it's a lot of these markets are going to be consolidating in front of tomorrow's move by the FOMC. And once you get that FOMC decision, I think that's going to drive all the technicals again, which for a technical analyst, that is a bit of an annoying thing to say, but I think that is sometimes you do get, as a focused on big fundamental shifts of policy, has a major impact that trumps all the technicals, and that could well be seen tomorrow. Certainly, if the FOMC doesn't have as much of a hawkish move as perhaps the market was expecting. Now, what you'd say is on this euro chart, I would be selling into strength. I think if they do, for example, not move on interest rates tomorrow or on the statement tomorrow, if they keep patient in, or they're seen to be removing patient, but then just talking about data dependency, and then you could even then speculate on the fact that the data in the US recently has been very well. I would say it's been pretty weak, pretty disappointing, backed up by, again, industrial production figures yesterday, and also the housing data as well. So not great housing market figures either. And I think it's sort of having this impact that it could well be that the FOMC tomorrow just sort of do remove the patient word, but then maybe introduce a new sentence that includes data dependence, and that would sort of mean the market then focuses massively on every single bit of data coming out, which makes our lives a lot more difficult, and also increases the volatility. So I think euro dollar is just settling in front of that, but ultimately I think euro dollar is coming back towards parity. Once you move away from the next Fibonacci level, you get towards 100.55, which is 100% Fibonacci projection level. Technicals across the board on euro dollar look dreadful. Even on the hourly chart, well, the hourly chart is more of a consolidation phase, but still I think that euro dollar is still under a lot of pressure generally on the daily chart. Cable, actually worse in the last few days than the euro dollar. Euro dollar's actually fared much better than cable recently. Again, euro dollar's up, but cable is lower by almost 100 ticks today, unwinding that move that we saw yesterday. And it certainly doesn't look great in terms of that. It's broken down the support of 49.50, and you got to go all the way back to 2010, back to where cable was last at these sort of levels. So it certainly is looking pretty down. And look at this, the RSI here on cable still has further downside potential. you'd argue, just gone back below 30. It got back to 15, and that 15 move was in September on the Scottish referendum in the UK. Now, dollar yen. Oh no, I haven't done that right, am I? JPY equals, that's annoying. Off. PY equals. Dollar yen has basically just gone sideways in the last few sessions. All these very uncertain doji candlesticks, just basically opening and closing at the same level, very tight candlesticks, just suggest that there's very little really going on in these in the dollar yen at the moment. So yeah, very much so that the dollar yen is sort of going sideways, sort of waiting again for this FOMC meeting. In terms of the hourly, interesting because it's just breaking this 2.5 week uptrend now, which has been used on numerous occasions actually through this, even yesterday and to a certain extent today, but it's now breaking that down. We haven't had a breakdown yet because that's 2107, and I just reading earlier that apparently there are stops hanging around the 21 big figure mark, so if you see it moving back below 21 it could move quite quickly. But the lows come in around that 2060 mark, and that I'm taking as the near-term important level. But again, momentum indicators on the hourly chart, basically neutral, nothing really doing yet. And until you get a move above this 2167 or below 2060, I don't really see that there's going to be any real direction you're going to get from this. Above 2167 reopens that 122 high, and then ultimately higher again. Above the multi-year high, but it certainly looks a bit sort of wishy-washy at the moment. Nothing major going on there. Now, gold is another one that's sort of going sideways. Although actually today it's fallen away a bit. It had been reasonably positive this morning. It had been sort of showing decent early signs, but it's just fallen away, isn't it? But you'd still argue, I suppose, that was just on a spike, and you're just still really just trading sideways, really. All these moving averages are flat on the hourly chart, momentum indicators neutral. But the fact that you're seeing lower highs and lower highs across the board, that's 75, that's 70, that's 66, that's 63. The fact that you're getting these lower highs consistently on gold really doesn't look all that great, and it looks as though you're still trading within this band. You're going to be pushing back towards the lows of 1142.43 and also 1131.85. But yeah, I mean, look at the momentum indicators, all bearish configuration. So what about the DAX? Wow. Big corrective move, but I mean the interesting thing is I've got here, I talked at length on my videos about this Fibonacci projection. That was a bull run from the October low to the December high, measured from the December low. Consolidated around 100%, which was interesting. Consistent consolidation as well. And then when you started to trade clear of it, again with the Fibonacci levels, when you start to trade clear, you then move towards the next level. And 12,022 was that target there, and it hit it. It's now starting to sort of slightly consolidate. Overbought on the RSI, and obviously we've had this big sell-off today. 188 ticks down, which is about 1.5%. And it certainly looks still very strong. I suppose you draw. Where's my? Give me a trend line. Just add that in there, see what that's doing. That's pretty decent, that's not too bad. So you'd say you're still in this nice uptrend from that December low. And that currently comes in around 11,600. Which broadly speaking, between 11,600 and 11,400, there's a band of support. So it looks fairly strong, as you would say. But this, I mean, is just the incredible move that we've seen on this on the DAX pretty much ever since we had the QE announcement. That was the day there of the QE announcement, the 22nd of Jan, and it's basically not looked back ever since. In quite significant contrast is my biggest bugbear on the markets, and that is the FTSE 100. FTSE 100 is still very, very tedious to trade. Had this slow drift higher. It's then sold off sharply, and you're getting a bit of reasonably positive reaction. But I would say that reaction could well be tempered if the Fed starts to sort of move down the hiking cycle. But looking at this chart, it's so rangy. It's such a trading range of a chart. No real conviction. There was a very, very slight move to a breakout, but that wasn't really ever confirmed. The all-time high was above 69.50, and it sort of tried on several occasions to break out, never really convincingly, and then just sold off. I think it's still in trouble, to be honest. I still think there's a correction in the FTSE potentially in the offing, certainly with certainly with the Fed's hiking cycle to come. Okay, let's got a few more minutes, I think, so I'm going to just quickly go through silver. Again, look at that. I mean, you've got this downtrend channel on gold. Not so much on silver. Not as tight. Sort of a bit tighter. But still, you've got the RSI confirming all this downshift in the price. You've also got the MACD lines confirming. Stochastics are also weak. You'd be selling that into strength. Anything back towards that downtrend is a selling opportunity. The ideal selling point, you would argue, would be around this $16 mark. Bit of a low here. But it certainly looks like you've now sort of breaking below that 15.50 mark. Not closed below it, interestingly enough. So it's not ultra bearish. And I think if you started to see a close below that 15.50 mark, which were these lows in December and January, then you're going to be coming back towards the 14.42 spike low. But it certainly doesn't look great. All the moving averages, all the momentum indicators, pretty bearish across the board there. So it's not looking great. And let's do oil, because oil is, let's do CLC1, which is NYMEX. Oh, God. Richard. CLC1. Capitals. Right, so last few days, let me just take that crosshair off and zoom in. Look at that downside. That's significant. 52.40. That is 52.40. And the downside has now broken below the 48.36 mark. Sorry, oh Christ, 43.58 mark. My mistake. It's broken below that, and that's a 6-year low now. And a big downside. And looking at these momentum indicators, there is more in this move potentially. RSI confirms obviously the breakdown of this range, but also has further downside potential. Look at these moves in December and January, got bound towards 20. RSI currently 32. MACD lines just turned over at the. I mean, that is incredibly, in my opinion, very negative, because it's just turned over at the neutral line and just starting to fall away again. And it doesn't look great at all. Doesn't look good. And just for fairness, LCO C1 is Brent crude. Now, I was on CNBC the other day, and I was saying that 53 to 54 is your support area. It's just sort of breaking below that. You sort of had this low around 53, and this one here around 54. So I sort of took that as 53 to 54 as the support area. and you have sort of broken below that. And look at these momentum indicators. Same story with the Brent crude price falling away. MACD lines, stochastics are really bearish, I would say, on this, and it certainly looks pretty negative. So yes, further downside, you could well see a test of back towards 50 now, interestingly, on that. So that is sort of wraps it all up. I mean, just very quickly, very briefly about Hantec Markets. If any of you haven't heard of us, we are regulated as a London-based broker. We're a straight-through processing broker. We don't take positions on the other side. We have no dealing desk. We are not a market maker. We basically just facilitate trades. We do not act against our clients. So therefore, I think that's a pretty good position to be in. Pretty happy that you can sort of listen to me in terms of what I'm talking about, and therefore maybe adds a bit of credence to it as well. In terms of spreads, we have got competitive spreads through the market. We use MT4 and CurrentX trading platforms. You can use our website for where is it? There we go. This is our website, hantecmarkets.com. Sorry, hantecfx.com, and this is my research side that I put all the output for. And I do a morning report. I do daily videos, as you can see down the side here, and we also give where our clients are sitting. We've got we do Twitter as well, Twitter account, and I do a weekly video. So yes, lots going on our website. So come and check it out. It's hopefully interesting for you. And that is pretty much it. If you want to sign up for our research, it's hantecfx.com/market-research, and you can sign up for the research direct to your inbox every day. My Twitter handle is @HantecRich if you want to engage with me. And also, if you've got any questions, please feel free to email me on marketing@hantecfx.com, and I'll be more than happy to answer your questions. So let me know, and I will speak to you again soon. Thank you very much for listening today.